Welcome back to Talk Tickers.
Yeah, it is great to be back for another one.
So if you are listening to this right now, there's a very good chance you spent the last 24 hours staring at a stock chart, blinking rapidly, and, just wondering if your trading terminal was glitching.
I mean, I refreshed my screen at least 3 times.
Exactly. Yeah. Or maybe you're just scratching your head trying to figure out why the stock market sometimes behaves like a rebellious teenager who just refuses to do what the report card says they should do.
Right. It ignores the obvious grades and just does its own thing.
Yeah. And that is what we do here. We are the deep dive that takes the earnings calls, the financial statements, the 10Ks, the completely chaotic analyst Q&As, and we strip away all that corporate gloss to find the actual mechanical story of the business.
And my job is to help you read between the lines of those financial statements. We are trying to figure out where the alpha is actually hiding.
Which brings us to today's topic. Our mission for this deep dive is to dissect a ticker that is pretty much synonymous with summer vacations, screaming at the top of your lungs, and, judging by this latest report, some truly baffling accounting gymnastics.
Yeah, it's a wild one.
We are talking about Six Flags Entertainment Corporation, ticker symbol FUN. FUN.
Which is a bit of a cruel irony, really.
It really is.
Because if you have been a shareholder of this company over the last 12 months, the experience has been about as much quote-unquote fun as, getting stuck upside down on a loop-de-loop for 3 hours in the rain.
It has been a brutal ride, no pun intended.
Right.
But we are focusing specifically on the Q4 and full year 2025 earnings call today. And I have to be honest with you, when I first saw the notification flash on my screen, I literally thought it was a typo.
It looked like a catastrophic error.
It did. If you just scan the headlines, you saw a massive loss, a number that would usually send a stock plummeting straight into the Earth's core. But, and here's the hook for today, if you looked at the price action,
the stock rallied.
It rallied. It didn't just tick up a little bit. It closed up about 8.38% on the day of the release.
It is one of the clearest, most textbook examples of a divergence we have seen this entire earnings season. I mean, you have a massive bottom line miss, a really scary headline number. But the market bid the stock up aggressively.
That is exactly why we are calling this deep dive the tug of war. It is a total battle between the ugly headline numbers, specifically a net loss that starts with a B, and a very compelling, albeit surprisingly boring, turnaround narrative led by a brand new CEO.
It is really a question of time horizons. That's what this whole print was about. The rearview mirror shows an absolute train wreck, but the windshield shows a roadmap. And the market, for once, actually decided to look through the windshield.
So the core question we need to answer for you, whether you're long, short, or just watching from the sidelines with some popcorn, is this. How do you post a net loss of $1.6 billion and have smart money rush in to buy the dip?
The answer lies in 2 concepts we are going to unpack in excruciating detail today. The revenue engine, and what I'm calling the boring execution play.
I love a good boring execution play.
Well, it's the best kind.
It usually means someone is actually just doing their job for once. But before we get to the fix, we really have to look at the damage. Let's do the autopsy on this earnings print.
We got to start with the ugly.
We do. Because that $1.6 billion figure is staring me in the face like a monster in a haunted house. What actually happened to the earnings per share?
It was a massive miss. Let's look at the GAAP earnings per share, or EPS. They reported a loss of 91 cents per share. Now, to put that in context, the consensus, that average of all the Wall Street analysts covering the stock, was expecting a loss of roughly 28 cents.
So they missed by 63 cents.
Yeah.
In the world of earnings, usually a penny miss is annoying. A 5-cent miss is a serious problem. 63 cents is usually a death sentence. That is a massive, massive deviation from expectation.
It is huge. And then you have that full year net loss figure, $1.60 billion for fiscal year 2025.
Okay, let's pause there, because I know we have listeners who aren't CPAs. If a company the size of Six Flags loses $1.6 billion in real money, like actual cash out the door, they are filing for Chapter 11 bankruptcy next week.
Absolutely.
But they aren't. The stock is up. Why?
This is where you have to separate accounting reality from economic reality. That $1.6 billion loss includes a massive $1.5 billion non-cash impairment charge.
Let's go really deep on this.
Yeah.
Define non-cash impairment charge for us. What actually happened on the balance sheet?
Think of it like this. Imagine you bought a house 10 years ago for $1 million. You have that asset listed on your personal balance sheet at $1 million. Today, you realize the neighborhood has gone downhill, maybe the foundation has a massive crack in it, and the market says the house is really only worth $500,000.
Okay, that makes sense.
You have to update your personal balance sheet to reflect that lower value. You write down $500,000.
So on paper, I just lost $500,000 today. My net worth took a massive hit.
Exactly. But, and this is the absolute critical part, did you actually write a check for $500,000 today? Did that cash leave your bank account?
No. The cash is totally safe. It's just the imaginary value of the asset on paper that changed.
Right. So Six Flags is basically admitting, hey, our brand, our parks, and our goodwill aren't worth as much on our books as we said they were yesterday.
Okay.
It looks terrible on the income statement, but it does not affect the company's ability to pay its electric bill or its employees. It is not cash burning.
It's a kitchen sink move, isn't it?
It's a classic kitchen sink. A new CEO comes in, John Reilly, in this case, and he looks at the books. He says, you know what, let's take all the pain right now. Let's write down every single bad asset, clear the decks, and take a massive loss in a quarter that is already messy.
That way, next year, when they don't have that charge, the year-over-year comparison looks amazing.
Precisely. It resets the baseline. So the market sees the $1.6 billion loss, panics for a millisecond, checks the cash flow statement, realizes the bank account isn't actually empty, and just moves on.
Okay, so that explains why the floor didn't fall out. Now, let's look at the good, because this is what actually saved the stock. Revenue.
Revenue came in at $650 million. The consensus was looking for about $616 million.
That is a $34 million beat.
It is. And remember, Q4 is a seasonally weak quarter. It's winter. Most regional parks are closed or operating very limited hours. Beating the top line by that margin in the off-season is significant.
And adjusted EBITDA.
$165 million for the quarter and nearly $800 million. $792 million to be exact for the full year.
Explain why we care so much about EBITDA here.
EBITDA earnings before interest, taxes, depreciation, and amortization is our proxy for the cash the business actually generates from its core operations. It strips out that $1.5 billion accounting charge we just talked about.
Right.
So $792 million in full-year EBITDA proves the business is solvent. It proves the turnstiles are generating actual cash despite all the accounting noise.
Okay, so the core business works, but there was a divergence in the operational metrics that I found even more fascinating than the accounting stuff. It almost seems like Six Flags is accidentally becoming a boutique operation.
You are talking about the attendance versus spending split. This is really the underlying story of the quarter.
Attendance was down significantly.
It was 9.3 million visitors in the quarter. That is a 13% drop year over year, a double-digit decline in foot traffic.
If you are a retailer and 13% fewer people walk into your store, you're usually holding an emergency board meeting. That sounds like a total disaster.
It sounds like the brand is dying.
But here comes the big but.
But per capita spending, the amount of money every single one of those guests spent once they were inside, skyrocketed. It hit $66.41, which is an 8% increase year over year.
So fewer people showed up, but the ones who did were the whales. They were the high-value customers.
Exactly. They bought the flash passes, they bought the premium dining plans, they bought the overpriced merchandise. This is the premiumization thesis in action.
What is the interpretation here? Is this inherently good or bad?
The market interpreted this data point as a massive signal of brand strength. It says that the customer demand for the high-margin product is totally intact. The customers aren't balking at the prices. They're willing to pay up for the premium experience.
So the problem isn't that people hate Six Flags. The problem isn't the product itself or their pricing power. The problem is just getting bodies through the turnstiles in the first place.
Correct. It is a volume problem, not a pricing problem. And historically, Wall Street believes volume problems are way easier to fix than pricing problems. You can market your way to volume. It is very hard to raise prices if nobody wants your product.
Let's dig into that volume problem, because a 13% drop in attendance is still huge. We can't just gloss over that and say, oh, well, the other guy spent more. Why did 1.3 million fewer people show up?
It basically boils down to two factors. One was an act of God, and the other was a completely self-inflicted wound.
Let's start with the self-inflicted wound. This was the part of the call where management really had to eat humble pie. It sounded like a confession.
They really did own it. The CFO, Brian Witherow, was surprisingly candid. He admitted they made a major strategic error regarding their winter events. They decided to cancel Holiday in the Park and other winter festivities at 4 of their major parks.
Just completely shut them down.
Dark gates, locked up, no lights, no Santa, no hot cocoa.
What was the logic there? Were they just trying to save on electricity bills?
Essentially, yes. It was a cost-saving measure. They looked at a spreadsheet, probably a very complex, very neat spreadsheet, and said, it costs X million to run these events, and the margins are thin. If we cut the events, we save the expense, and our margin percentage technically goes up.
It's spreadsheet logic versus real-world logic.
Exactly. Withero admitted it was a broad-brush decision. They applied a generic corporate strategy to specific markets without really understanding the local demand.
It backfired.
Spectacularly. That decision alone cost them approximately 425,000 visits.
Nearly 500,000 lost customers just because they tried to pinch a few pennies.
And the kicker is, it actually hurt profits. The revenue they lost from those 425,000 people was greater than the fixed costs they saved by closing the park.
It is the classic corporate mistake, cutting costs to the point where you actually cripple your ability to generate revenue. They were stepping over dollars to pick up dimes.
That is the perfect phrase for it, stepping over dollars to pick up dimes. But looking forward, Witterow said they are going to reevaluate this market by market for 2026.
So this is a highly fixable error. You just reopen the gates next year.
Yes. You turn the lights back on, hire the guy in the Santa suit. It's an easy lever to pull to get that attendance back.
And the second factor was weather.
Yes. And look, you can't blame the CEO for rain. Q4 2025 was historically wet for their key markets. They had 15 park closure days in the quarter.
Compare that to a normal year for us.
The prior year only had 3 closure days. So that is a 5x increase in days where the revenue was literally zero because of storms.
When a park closes for weather, do they save much money?
A little bit on variable labor. You send the hourly ticket takers home. But the roller coasters are still sitting there depreciating. The debt interest is still accumulating. The insurance premiums still have to be paid. The fixed costs eat you alive when the revenue is zero.
Okay, so if you combine the we accidentally closed the park strategy with the rain closed the park reality, that negative 13% attendance number suddenly looks like an anomaly, not a structural trend.
That is the bull case in a nutshell. The revenue engine isn't broken, it was just turned off. If you assume normal weather, just strictly average weather, and a smarter calendar strategy for next year, attendance should naturally mean revert back to growth.
Which brings us to the architect of this fix. Let's talk about the new CEO, John Reilly.
He is fresh. He effectively took over on December 8th, 2025. So he has been in the seat for about 10 weeks. This was his debut to the public markets.
And what a debut it was. Usually new CEOs come out with these flashy slide decks. They talk about synergies and paradigm shifts and omni-channel experiential ecosystems. Reilly came out and talked about forklifts.
It was incredibly refreshing. And it connects directly to his new mantra, which is operational discipline, or as I like to call it, the boring execution play.
I really do love the boring execution play. Tell us the stories, because the air compressor story is already becoming legendary on the trader forums.
It is a total classic. So Reilly is touring Magic Mountain. He is walking the maintenance sheds, talking to the mechanics on the ground. He finds out the park is renting an industrial air compressor.
Just a standard piece of shop equipment, nothing fancy.
Right, just an air compressor. He asks to see the invoices. They are paying $32,000 a year to rent this machine.
$32,000.
Annually. Then he asks the completely obvious question, how much does it cost to just go buy one? The answer is $35,000.
Wait, I want to make sure I heard that right. For a one-time payment of $35,000, they could own the asset forever. Instead, they were paying $32,000 every single year.
Indefinitely. It is literally a 10-month payback period. After that, it is pure profit. But nobody had done it.
How does that even happen? How does a multi-billion-dollar corporation let that happen on their watch?
It is the difference between OPEX, operating expense, and CAPEX, which is capital expenditure. In a lot of big companies, it is super easy to get approval for a monthly rental fee. It just hits the operating budget. The local manager has signing authority for that. But to buy a $35,000 asset requires a capital expenditure request.
Oh, the red tape?
Exactly. It needs 3 signatures, a committee review, maybe a PowerPoint deck explaining the ROI. It is pure bureaucracy.
So the local manager just takes the path of least resistance and rents it.
Exactly. And the shareholders foot the massive bill.
And he had another one at Knott's Berry Farm, right?
Yes. At Knott's Berry Farm, renting a forklift costs $19,000 a year. Buying it is $14,000.
That is even worse. They were paying roughly 135% of the asset's total value every single year just to rent it. That is clinically insane.
It borders on financial malpractice. But Reilly didn't share these stories just to be funny or to embarrass his park staff. He was signaling to the market. He is saying, look at this low-hanging fruit.
Yeah.
If I found 2 crazy examples in my first month just by walking around the maintenance sheds, imagine how many millions of dollars of waste are hiding in the cracks of this entire company.
It changes the thesis completely.
Yeah.
It shifts the whole narrative from we need to find more customers to we need to stop being stupid.
And stop being stupid is a much easier promise to keep. Margin expansion via basic cost discipline is entirely under management's control. They don't need the macroeconomy to boom, they just need to go buy the forklift.
It is a really compelling pitch.
Yeah.
He also mentioned an employee feedback loop, right?
Yes, over 300 ideas submitted by park staff already. The guy operating the ride knows exactly what is broken. The mechanic knows about the rental scam. Reilly is finally just asking them.
I want to touch on one more operational point he made, ride-up time. He spent a lot of time talking about restoring coaster trains to service. Why is this so critical to the actual bottom line?
It is all about throughput. It is simple math. If a roller coaster runs 2 trains instead of 1, the line moves twice as fast.
Right?
If I am a guest and I am standing in line for 2 solid hours, what am I doing?
You are staring at your phone and getting angry.
Right. Am I spending any money?
No, you are physically trapped in a queue.
Exactly.
Yeah.
But if the line takes 45 minutes instead of 2 hours, you get off the ride. You suddenly have an hour of free time, you buy a pretzel, you play a carnival game, you buy an overpriced soda.
And I'm happier about it.
Yes. Guest satisfaction scores go up and per cap spending goes up. Ride-up time is directly correlated to revenue generation. It is a pure efficiency story.
So, we have a plan. We have a fixer CEO who clearly carries a calculator. But we have to look at the balance sheet. Because all the operational efficiency in the world does not matter if the debt crushes you. And Six Flags has a lot of debt.
They do, and this is the bear case anchor. But management navigated this pretty carefully on the call. First off, they outright refused to give formal 2026 financial guidance.
Which usually spooks investors. Yeah, saying we aren't telling you what we think will happen is usually Wall Street code for we have absolutely no idea.
True, but in this case, it was seen as prudent. Reilly is brand new. The summer season hasn't really started yet. Getting a hard number right now would just be guessing. But they did give guardrails.
What are the guardrails telling us?
CapEx, capital expenditures, is guided down $400 million to $425 million. That is lower than the previous run rate of around $475 million. It shows they are being very disciplined with capital. They aren't going to build giant new monuments to their own ego. They are just fixing the parks they have.
Spending money on air compressors, not shiny new headquarters.
Exactly. Interest expense is expected to be $135 million to $145 million. That is the cost of just servicing the debt. It is a heavy load. But they made a really crucial point about leverage.
You mean the debt to EBITDA ratio?
Right. The ratio looks terrible right now. It is high. But management argued that it looks terrible mostly because the denominator, the EBITDA, was artificially low in 2025 because of the terrible weather in the closed parks.
So if EBITDA bounces back to normal historical levels, the leverage ratio naturally fixes itself without them having to pay down a single dollar of principal.
Precisely. It is deleveraging via growth. You grow the denominator. And the bond market actually seems to buy it. They refinanced their April 2027 notes in January.
And that offering was oversubscribed.
That is the single most important signal for their financial health. Oversubscribed means there were more lenders wanting to give Six Flags money than Six Flags actually needed.
What does that tell you about the risk?
It tells you that the smart money, the credit market, the bond guys who really sit down and do the hard math are effectively saying, we are not worried about bankruptcy. They are perfectly willing to lend.
And if the bond guys are sleeping well at night, the equity guys can take a breath. Are there any green shoots for 2026 yet?
A few. They mentioned pass sales and memberships have accelerated since year-end, and they launched a new regional pass architecture.
What exactly is that?
It encourages people to visit multiple parks within a specific geography. It is an upsell tactic. It drives that initial ticket price higher. So the early leading indicators suggest the core customer is still very engaged.
Let's pivot to the investor context. We have to talk about the stock price, because Talk Tickers isn't just about business analysis, it is about the trade. The valuation gap here is incredibly stark.
The context is brutal. The stock is down roughly 60 to 65% over the last 12 months.
While the S&P 500 is hitting all-time highs, it is up 14% in the same window.
Exactly. Even the sector peers, Disney, SeaWorld, Cedar Fair, are flat to up slightly. Six Flags has just been left for dead in the basement.
But that gap is exactly where the opportunity lives.
It is an asymmetric setup. When a stock is down 65%, the market has basically priced in absolute failure. They have priced in a deep consumer recession, a management collapse, and perpetual rain.
So the bar for success is incredibly low.
Exactly. Six Flags doesn't need to be perfect. They just need to be not a disaster. Any sign of basic competence causes a massive re-rating. That is exactly why we saw that 8% pop on the earnings. It wasn't because the earnings were fundamentally good. It was because the plan sounded sensible and the CEO sounded competent.
It is the ultimate show-me story.
The bull case is simple. Operational leverage. These parks have high fixed costs. It costs the exact same amount to run the coaster for one person as it does for 1,000. Once you cover those fixed costs, every extra dollar of revenue flows straight to the bottom line. If Reilly fixes the volume, the cash flow explodes.
And the bear case. We always have to be balanced here.
The bear case is the macroeconomy. If we hit a true recession and people lose their jobs, they do not go to regional theme parks. And because Six Flags has high debt, they can't handle a prolonged revenue drought. It is a race against time. Can they fix the operations and build a massive cash cushion before the economy potentially slows down?
That is the wager. Okay, let's get reckless. It is time for the not financial advice segment.
Disclaimer time.
Yeah.
We are just two voices on a deep dive. We are absolutely not your financial advisors. Do not trade based on this. Do your own due diligence. This is purely for entertainment.
But looking at this setup, the turnaround turbulence, the high volatility, the super compressed valuation, if we were pitching a trade idea to a hedge fund committee today, what would it be?
I call this trade the roller coaster straddle swap.
The roller coaster straddle swap. That sounds wonderfully complicated and a little dangerous. I love it. Break it down for us.
The underlying logic is this. We are entering the high-stakes summer season. Q2 and Q3 are absolutely everything for Six Flags. Q1 is going to be messy because Reilly is still cleaning house. So we expect short-term volatility, but a significant midterm pop if the plan actually works.
So how do we physically structure it?
Step 1, long the equity. You buy the actual stock here. You want to capture the recovery from these historical negative 60% lows. You want real skin in the game.
Simple enough. Buy the stock.
Step 2, sell out of the money puts for July.
Explain the specific mechanics of that for the listeners.
You pick a strike price, maybe 10 or 15% below where the stock is trading today. You sell that put option. You essentially become the insurance provider for someone else. You collect a premium hard cash in your pocket today.
And what is the risk of doing that?
If the stock crashes below that strike price by July, you are legally obligated to buy more shares at that lower price.
Which, if you are fundamentally bullish on the turnaround anyway, you are perfectly happy to do. You are basically getting paid to set a limit order to buy the dip.
Exactly. You lower your overall average cost basis. But here's the outrageous kicker. You take that cash premium you just collected from selling the puts, the free money essentially, and you use it to buy deep out-of-the-money calls for September.
Oh, wow. So you are financing a total moonshot bet with the income from the puts.
Correct. You are betting that by September, the critical summer season data will be out. We will know if the revenue engine worked. We will know if the forklifts were bought. If the news is genuinely good, a stock that is down 65% could double very quickly. Those September calls would go totally parabolic. You are essentially betting that John Reilly knows how to buy an air compressor.
It is a brilliant way to leverage the upside without pulling more cash out of your own pocket to fund the option premiums.
It is aggressive. It perfectly fits the ticker. It is a roller coaster trade. You are betting on the volatility working completely in your favor.
Fascinating setup.
Yeah.
Again, purely theoretical, but it really highlights how professional traders look at these distressed situations. It is not just about passively buying and holding.
It is not about betting on the company being perfect. It is about betting on the company being significantly better than the market expects. And right now, those expectations are buried in the basement.
So let's wrap this up. What is the final takeaway for you, the listener, as you digest all of this?
Six Flags totally missed the numbers. They lost a ton of money on paper, but they completely won the narrative war. They successfully shifted the market's focus from what went wrong in 2025 to look how easily we can fix this waste in 2026.
It is no longer a growth story at all. It is purely an efficiency story.
And the market loves a good fixer-upper, especially when the entry price is this cheap. It is exactly like buying a house with good bones but a leaky roof. You know exactly what needs to be done.
John Reilly has his toolbox open. He is buying the air compressors. He is fixing the coaster trains. Now we just have to wait and see if the crowds actually come back to the gates.
We will be watching those weather reports for Q3 very, very closely.
Always watch the weather. And for heaven's sake, check the operating calendar before you trade the stock. Do not bet on a park that isn't even open.
That is rule number 1.
But it does leave you with one final thought to mull over. If Reilly manages to fix the operations and cut the fat, these regional theme parks are essentially local monopolies. You can't just build a new roller coaster next door. If inflation stays sticky, a perfectly run local monopoly with total pricing power might just be the ultimate inflation hedge hiding in plain sight.
That is a very interesting way to look at it.
Something to think about. Thanks for joining us as we unpack the numbers. We will catch you on the next deep dive. See you next time.